battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
Hi there, ladies and gentlemen. Welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Welcome back to episode 129. Unbelievable. We are almost to October. Hard to believe how fast this year has gone. Thank you for coming back each and every week to get the data, math, statistics, the reasons why you should stay on your plan. Nothing proves that more than the volatility that we have just had lately. I put out a market minute video. I hope you watched it. If you haven't, it's on YouTube. Go check it out. We also have been doing client quarter videos every month or so. Get the data, get the good news, because we are possibly going to be in some volatility here for the next couple months. I do think, just to fast forward to our long run predictions, that over the next 6 months, especially the next year and beyond that, the next 18 months, we are going to see brand new highs on the S&P 500. And I know there's a bunch of reasons why you may think that's not possible or not going to happen. Lots of doom and gloom, lots of negativity, but don't let a small market correction like we're in today, a 7% decline, make you panic and start buying into this narrative. Yes, there's narrative. There's always been narrative. There's always going to be narrative. And for the 10 reasons that you ought to pack up and panic and sell all your stocks this year, just remember, next year in 2024, there's going to be 10 brand new reasons. And by the way, if I asked you what the 10 scare stories that you were worried about last year are, you wouldn't remember. There's no way. People don't remember the year before, 2 years, 3 years, 4 years. It's all ancient history. But you will remember if you held your stocks through a crisis. So stay on your plan. Don't panic. Don't get spooked. And that's the title of this week's article, The Fed Spooks Investors. Do not let yourself be one of the people getting spooked. Couple of big stories for the show this week. Number one, the UAW, United Auto Workers, and the politicization of the strike. I think one of the problems that you're dealing with up there, right or wrong, is the fact that CEO comp has risen dramatically. That's what everybody's talking about. It's not the only reason, but you are seeing that the top brass at these companies outpace their counterparts at other companies from a CEO employee pay ratio standpoint. And it's not, I don't think it's inherently a bad thing, but it's certainly an indication that if you let this go unchecked for too long, you could deal with problems. Now, what's sad about all this, and you're seeing it, that Elon Musk at Tesla is not dealing with these same problems, is the fact that this could, in my opinion, be the bankrupting eventually of Ford, GM, Stellantis, a lot of the American car manufacturers. Who knows if the car manufacturers get bailed out again like they were before, but it certainly is not good. And if they pay the workers what they want, they are going to be in a precarious situation. You've seen Elon Musk just fly right through not having to deal with these same problems, who has streamlined the manufacturing process, not dealing with the union issues. And that's what's made Tesla much more competitive. So I think it's just a great example of the free markets beating the markets that are run by the government or central planning. And you've seen this happen with GM. Now, Ford has outperformed much, much better than GM has the past 5 years, because GM in particular was literally taken over by the government. You have to remember, they took a ton of cash from the government. They have been forced now to go towards EVs. And that's part of the reason why, in my opinion, the workers are striking too. And so when you have this centralized planning that says we have to push towards ESG and EVs and electric and oh, this is the future. Well, maybe it is. I don't know for sure. I don't know if any of us are smart enough to know what it's going to look like in 5 or 10 years. But I do know that it's going to be very tough to get completely off fossil fuels. That is going to be tough. And there's just not a lot of demand, enough demand to keep all these EV players in place over time. So I think eventually you're going to see Ford and GM have to pivot back to gas burning cars, or they could face extinction. And the reality is Elon Musk and Tesla are so far advanced. They're so far ahead engineering wise. I don't know if these other guys can catch up. So that is the major concern there. That's what people are talking about. You're seeing the looting and all the rioting going on in Philly here, and Target closing down stores. I'm not going to make a comment on the rioting and the looting, but I do want to say this is a signal of a broader problem that's happening in retail across the country. And it's sad, actually, because these communities that these stores operate in, you've seen this in San Francisco now, where Nordstrom was forced to close. You're seeing this in Philly. You've seen this all over the country with these riots and looting. It's ultimately going to hurt the communities that these places are in. The stores will go offline. They will say, we're not going to do business here. We're going to close down. By the way, Target is massive, not like a Walmart's just going to come in tomorrow and pick up that empty real estate. That creates a lot of societal problems in that community too. And then beyond that, we've got the internet nowadays. So Walmart, to be effective in Philly, does not have to come in and take Target's lease over and start doing business as a brick and mortar store. They've got a website. It's called walmart.com. Same thing with Amazon. And ultimately what happens is all of this rioting and looting is going to make these places terrible to live in because people are not going to invest. Entrepreneurs, businesses, when they see lawlessness, are going to stop investing in these regions. And that's the concern I have, is if we don't turn things around from a law and order standpoint, eventually we are going to have a really tough time getting people to invest. And that's what you see in a lot of societies that are in, especially third world countries and places in Latin America, where it's so dangerous to do business, and eventually that area crumbles. So hopefully we can turn things around there. One thing that people thought was going to be good news this week, which was not good news, it was the opposite, was the Fed came out and said they're not going to raise rates for now. And I think what happened, I talked about this in Market Minute the other day, is the fact that you don't have to necessarily have the Fed raising rates to see bond prices go down or see the market correct. Why? Because all we have to do as an economy, and I think this is really what people are mostly concerned about, is avoiding a recession. And if we avoid recession, sounds like a great thing. Oh, we avoided a recession. I do agree. It is a good thing if we avoid recession. People keep their jobs, things are much better. But if we avoid recession, what ultimately occurs is the government will probably be printing less money and also be shrinking. The Fed will be shrinking its balance sheet further. And that's why long-term yields are going up. The Fed doesn't have to raise short-term interest rates to accomplish their goal. All they have to do is continue unwinding their balance sheet. It's this process of quantitative tightening. And I want to go back to my first point, that this is another form of failed central planning. It's a failed form of concentrated government in too few hands. And I'm not saying it's just the Democrats. I'm not saying it's just the Republicans. It's both sides. And both sides have worked together over time to get very extraordinarily wealthy. Saw that song, Rich Men North of Richmond. They asked Oliver Anthony, what was that song about? Do you like Republicans? Do you like Democrats? He said, I'm in the middle. I don't like either of them. I want smaller government. This is what people want. We have to have it. We've got to get government to shrink. We have got to get the Federal Reserve out of the way. And the founders argued about this. They said, we don't want a Federal Reserve because as soon as you centralize money, money controls everything. That's how you get people to do things or not do things, is to control the economic environment. And they knew this. And that's why a lot of the founders warned about a central banking system. Well, here we are all these years later. And unfortunately, the Fed has become way too powerful. So I think what you're going to see, and here's the impact for investors, is the long end of the curve. Long-term bonds, which have been inverted, long-term bonds are paying less interest than short-term bonds. I think you could start to see the long end of the curve rise even further. Bill Ackman came out, famous hedge fund manager, today, and said he thinks long-term bonds could rise to the 5.5 or 6% zone. And that would be a huge issue if you own 10, 20, 30-year paper. So what have we said for weeks and weeks and months now? Even maybe going longer, 18 months, is don't buy long-term bonds. Why? They're a huge risk. So stay put. Maybe at some point it makes sense to add duration. I think it's way too early. So stay the course. Now, The other thing you have to be careful of is, as rates go higher, is owning junk. You do not want to own junk stocks. You don't want to go bottom barrel fishing and pick up risky tech stocks or risky small caps or mid caps. You want to stay high quality, in my opinion, blue chip, large cap companies. Not that they're never going to go down or have a correction, they will. But more importantly, that when they go down, they have a higher chance of going back up. All right. Last thing I want to talk about is the current level of goods and services inflation, how the value of our dollar has plummeted. You have to be very careful. Brian Westbury at First Trust Portfolios, our friend in Wheaton over there, talked about this extensively, that it's not that your car costs more, your house costs more, your pizza costs more. It's that your dollar buys less car, your dollar buys less house, your dollar buys less pizza. That's the reality. But I want to also just say, I do not think that the inflation we're living in is actually going to slow down consumers as much as people think. I think it's going to slow it down a bit, but I do not think that this is a sign of all out collapse coming. And so you have to be careful about this narrative, because at some point, let's say the Republicans take over the government here in the next election cycle, their whole story is going to be, well, we inherited a mess from Joe Biden, which they largely did. Biden did not have to do a lot of the print and spend that he did. He didn't have to do Inflation Reduction Act, didn't have to do American Rescue Plan. It was a mess. That's why we have these issues. But they will point to these issues and they're going to say, this is what's taking out the consumer. I don't think that's necessarily going to happen to the magnitude people think, because at the same time as having these record high mortgage rates and house prices and car prices and car rates and all this stuff, finally, just now, these things have caught up with long run averages. Car prices have not moved in 20 years. Home prices really stayed stagnant unless you were on the coast. Here in the Midwest, home prices haven't moved until COVID in 10, 15, 20 years. Finally, now these things are catching back up. So it's not good. I'm not approving of any of this. I'm not saying it's good. I know people are struggling out there, and I'm very concerned for the millennial generation, which is really having a tough time. I think they're going to continue having a tough time. But as far as broad economic trends are concerned, is it going to take out the economy and ruin the stock market? I just don't think so. And part of that is because most of the wealth is concentrated with baby boomers, just natural. They've been around longer, had longer for compounding. That's not something that's unfair. It's not something that's wrong in society. It's just life. The longer you've been around investing and earning money, the more money you're going to have. That's just math. So it's not a bad thing. It's just true. It's the fact that the baby boomer generation is in great shape. And across the board, baby boomers have more cash than ever before. They're spending that cash. They're going on trips. They're spending money. They're going to leave trillions of dollars to the next gen through the wealth transfer that's coming through the year 2033. So don't get bearish and pessimistic here. It's just not founded in the data. And yes, there's going to be short-term declines. Yes, there's going to be little problems with student loan payments restarting and all the rest of it. But it's not a reason why the broad economy is in my opinion, going to get whacked. Most of the spending that happens in this country is from the baby boomers that are not having to take on leverage. They're not having to finance houses and cars at 7, 8, 9% interest rates. And again, I'm not rooting for this. I'm not saying it's good for the millennials, but broadly speaking, as far as the data is concerned, it's not going to take us out. Let's get into this week's article, The Fed Spooks Investors. Data shows that high-quality stocks produce relatively strong performance across an entire hiking cycle. That's the story this week. You have to get the data. I keep saying this each and every week. Don't just hear a story, a narrative, an anecdote that somebody tells you and say, oh, this is a sign of what's to come for the rest of the economy. If you look at history, you look at what actually happens, statistically speaking, data show that high quality stocks produce relatively strong performance across an entire hiking cycle. And so when you start out hiking rates, obviously stocks adjust down in the short run because they're long-term assets. But when you look at the average hiking cycle, after stocks are down 15, 16%, across the entire cycle, start to finish, stocks usually end up about 25% on average. Why? Because the direction of rates matters much, much more than where rates are currently. So if rates are at the point where they're today, 5.5%, that's not really the issue. The issue is, where are they going in the future? People think rates are going down in the future, and I tend to agree. I don't think they're going to go down as fast as people think, but I do think by the year 2026, maybe even 2025, definitely not 2024, we are going to have lower interest rates. And because of that, we are going to value stocks at their long-term forward price to earnings ratios of around 19 or 20. That's what Dr. Jeremy Siegel said from the Wharton School. We had him out for clients just a couple weeks ago, and he's been right over the long run, stocks for the long run. So do not get bearish here. Do not panic. While it's likely that 2024 interest rates are not dramatically lower than they are right this second, I do think 2025, 2026 rates will be. And so if you're a person who is about to maybe retire and you have a lump sum pension, you've seen your pension drop in value the past couple years with the interest rates going up, just stay put. My advice would be try and wait it out till 2025, maybe 2026. Easier said than done, I know, but just try and wait it out, because I do think you're going to pick up some substantial growth on your lump sum pension if you just wait things out. Okay. Here's what's happened in the equity markets this year. U.S. stocks have outperformed. It's just been not even close. The only shining part of the international market has been developed Japanese stocks, developed international, specifically Japan, but currency hedged. If you didn't hedge currency in Japan this year, you'd be up about 7 or 8%. If you hedge the currency, you're up big time. So you cannot point to these one-off countries or one-off currency hedge plays where things work out really well one year. Because if you look at 10 years, it doesn't work out. It hasn't worked out for international. So you're going to continue to see this. Europe is not the place where entrepreneurs are moving to build companies. Okay. China, who in their right mind would go to China right now and start a new company, a tech company? You would never do it. Okay. Because in short order, you will get thrown in prison if you're too successful, or you say something President Xi doesn't like. So yeah, we've got problems here in the US. We've got our issues. We've got headwinds and all. I understand all that. But we're still the shining city on the hill. We are the best place that you're possibly going to invest, the best place you're going to go. US has continued to be number one. The other big thing that we've watched is the difference in small, mid, and large caps. Large caps outpace small and mid dramatically. And I think that's a trend you're going to keep seeing. Smalls are not a place I'd go right now. I still think you got a lot of risk ahead. And the reason why is regulation, margins are going to come under pressure. And the small caps in particular, which happen to be lower quality when you buy an index fund, are also exposed to a lot more credit risk. Financing costs are going up. This is a big problem. So just be careful with some of the lower quality like we talked about. I've said in the past, I think we have a black swan event coming. We're overdue for one, either in 2024 or 2025. Don't let that throw you off. A black swan event will be a buying opportunity. Every black swan on record, COVID, the tech bubble, 2008 and 2009, the savings and loan crisis, every black swan on record, without exception, has been a buying opportunity. You're telling me you're going to sell your stocks when they're down 30, 40%? No, of course not. You should be adding more. It's simple. So you got to rein in your emotions. You got to rein in how you feel and get down to the data. And if you can't do that, call somebody like us, call fiduciary financial advisors, somebody who can keep you on a plan and say, hey, when times are tough, let's get more invested. That's how you make your money. You make your money during the bear markets, even though you may not know it at the time. That's when you add return to the portfolio. So here's what I think is going to happen. If we have a black swan that happens to be a war with Russia, and I'm not calling for this, I'm not saying for this, I'm not rooting for this, I'm rooting against it. I hope we, of course, don't end up in a war. That's awful. But it's possible we do, as a distraction for some of the problems we have here at home. I would certainly be favorable for the president if he got us into a war. And I'm not saying I would be in favor of it. I'm just saying politically, wars do help presidents get reelected. Sad to say, it's true. If we do get into a war with Russia, the government spending is going to go right back off the chart. And all the people that said we'd be in a recession already missed the fact that, yes, M2 was falling going into the beginning of this year, but now it's recovered and money supply is going up. The government actually has printed more dollars into existence, if you can believe it. So this is a Band-Aid solution. It's not a long-term fix. MMT, modern monetary theory, which has been tried everywhere and failed everywhere, has never worked. Milton Friedman said it's kind of like drinking. You'd have a little buzz at the beginning, but the long-term ramifications of drinking, hangovers and illness and death and sickness are just coming. It's just a matter of time. Same thing with government spending and printing money. Yeah, it seems great at the time. It makes you have a little shot of morphine in the moment, but over time, you will pay the price for printing dollars. And that's where we're at today. We're continuing to print more money. All that to say, if we end up in a black swan or a war or something, we could be in the middle of a recession. You may think this, Nick, this sounds absolutely bonkers, but we could actually see stocks go up. Why? Because government print and spend sends stocks up. So do not panic today. Do not get nervous. Something's going to happen at some point. It's just historical. It's just math. It's just statistics. It happens. We will have a black swan, and we could actually see stocks rally through that potential black swan. So do not panic. Don't get off your plan. In the end, once it's all said and done, black swan or not, the Fed will continue to raise rates and shrinking their balance sheet until something breaks. I think the big question now is, what are they going to break first? It's probably small business. It's probably the individual. It's probably millennials. Maybe in the form of layoffs. We're watching that very closely. I do talk to a lot of people out there who run businesses. I talk to management teams through our show Bullish, which if you haven't watched it yet, go on YouTube, watch Bullish with myself and Sam Hardy, where we cover earnings and all the S&P 500 companies. They're starting just now to talk about potential layoffs. It's not big. It's not really getting picked up in the AI yet, but it's coming. And I do think that we are going to have a wave of layoffs with small caps that are going to say our financing costs are double what they were last year. They're triple what they were in 2021. We're going to have to reduce headcount. And if enough companies do that, that's where the Fed will really probably back off. And I think what they're trying to do, they talk about this with the Federal Reserve all the time, is that they have a toolkit. They want to have enough tools available in case we get into a black swan to be able to react properly. And so what they're going to try and do is they're going to try and keep rates high until something breaks so that they can come in as the heroes and try and save the day. Just remember, they created the mess in the first place. They are not saving the day. It's simply like Ronald Reagan said, government trying to fix the problems it created. So be aware of this. This is not a good thing. This is not something that we want long-term to have a functioning society and a healthy society. But it's the reality of a big government, big Fed, big business, all working hand in glove to further the interests of the rich men north of Richmond. So just be careful with all this stuff. It's not good. We don't want this to happen for our kids and grandkids and great grandkids, whether you're left, right, center, red, blue, purple, whatever you believe in politically. You should want a smaller government. You should want the government to shrink in size and get out of the way of individual. So that's our philosophy. That's what we want. Now, the reality is, and this is what we'll end the show on today, is how do you invest in light of the things you don't necessarily like to see in the economy, you don't like to see in the government? How do you continue investing with that reality? And the fact is you have to be high quality. I've said this for so long. The biggest companies will continue to get bigger. Big government favors big business. It's not an accident that the bigger government gets, the bigger business gets. That's not just by happenstance. That happens in lockstep anywhere and everywhere. It's been tried in the world. And so I just think you have to really stay high quality. You can benefit from these rising interest rates. You can benefit from rising inflation by being invested in companies that either don't get affected that much by higher interest rates, like big tech, the Magnificent Seven, or second of all, being in companies where they have a high degree of operating leverage. So either rates aren't really going to affect them, like I said with big tech, or number two, they can do layoffs, or maybe they've got enough cash on their balance sheet just to cover their debt in the first place. and they're not going to be exposed to some of the risks, the credit problems that are coming. And so again, just be careful with what you're buying. You have to be selective. This is our belief. Remember, we have done an active management rebalance process. We are coming up on it right now. We're in the thick of it. We had about 4 or 5 meetings this week already. Bond's got us doing another 10 or 12 next week, a couple more after that. We will make a couple final decisions, but it's turning out that a lot of the same structural things we put into place for clients the past 3 to 5 years that have worked so well are going to continue in this rebalance. I just think you're too soon if you're going to add duration. I think you're a little early here on small caps. Maybe at some point they'd be a buy, but I think it's still a little bit too soon. We don't know the full effects of declining quality in credit markets. So that's how we're managing portfolios. A lot more of the S&P is becoming unprofitable, so we're actually looking to get rid of some of the lower quality names in the S&P, keep you in the best stuff, the biggest names. The big, I believe, will continue to get bigger. So all this to say, we're in a 7% correction. When it's all said and done, we could easily be down 10%. We may even be down 15%. I'm already putting cash to work in my own portfolio. We're putting client cash to work where we've been holding some reserves this year. Why? Because you cannot catch the bottom. You have to go off of what is the current value of profits and what is the market worth on those profits. Right now, the S&P is trading at 4,300 points. It's not the cheapest it's ever been, but it's sure a lot cheaper than it was this summer. And so I would be staying positive, using this as a buying opportunity. Yeah, you could see things decline in the short run, but I think long run, we're going to see profits continue to rise. We're going to see businesses make it through this cycle, and you're going to see stocks go up over the next couple of years. So stay positive, stay optimistic. If you're about to retire, we want to get 2 to 3 years of living expenses started in a short-term treasury portfolio that we manage. After that, as you get into retirement, you may want to increase that to maybe 4 or 5 years, perhaps. These are all things that you can do with a financial advisor on an individual plan. And if you've got a plan that's not risk-based, it's goals-based. It takes into account all the things you're coming up against, all the things you want to do, retirement, all the rest of it. If you stay on a goals-based plan, you will make it through this alive. Thank you so much for being with us on this week's episode. We'll see you next week for episode 130.